I need you to stop what you're doing and listen carefully for the next 60 seconds, because what I'm about to tell you could put $6,000 back in your pocket. $12,000 if you're married. And if you miss it, that money is gone forever. Right now, in 2026, the IRS is processing tax returns from millions of retirees. And according to tax professionals across the country, 1 out of every 4 seniors over the age of 65 is accidentally overpaying their taxes by thousands of dollars. Not because they did anything wrong, not because they cheated on their returns, but because they don't know about a brand new form the IRS created last year that almost nobody is talking about. The form is called Schedule 1A. It didn't exist 18 months ago. It was created specifically to handle the largest tax break for retirees in a generation. And if you don't fill out Part 5 of this form, you lose up to $6,000 per person in deductions per year for 4 straight years. That's potentially $24,000 per person. $48,000 per couple. Gone. Not because you weren't eligible, because nobody told you the form existed. The IRS just created a brand new tax form that didn't exist last year. It's called Schedule 1A, and according to tax professionals across the country, 1 in 4 seniors is going to miss it completely this filing season. Not because they're not eligible, not because they don't qualify, but because the IRS made it so confusing, so buried inside the fine print that most retirees won't even know it exists until it's too late. This isn't a conspiracy. This isn't clickbait. This is a real, documented, written into law tax break worth up to $6,000 per person, $12,000 per couple, that fewer than half of eligible seniors are going to actually claim. And here's the part nobody is telling you. The window to use it closes forever in 2028. After that, unless Congress acts, this deduction disappears completely. Gone. Erased from the tax code. So today, I'm going to sit down with you at the kitchen table, calmly and clearly, and walk you through exactly what this is, who qualifies, how to claim it, and the 4 traps that are costing retirees thousands of dollars they are legally entitled to. This is the video I wish every retiree over 65 would watch before they sit down with their tax preparer in the next 60 days. Let me start with the backstory, because the truth is more interesting than the headlines. On July 4th, 2025, President Trump signed a massive piece of legislation called the One Big, Beautiful Bill Act. The media focused on the big headlines: no tax on tips, no tax on overtime, higher child tax credits. But buried inside the bill was something specifically for Americans aged 65 and older. A brand new deduction worth $6,000 per person, in addition to every other deduction you already get. Trump had promised during his campaign that he would eliminate taxes on Social Security. This deduction was the compromise. It doesn't technically eliminate Social Security taxes. Instead, it gives seniors such a large extra deduction that, for roughly 88% of retirees, their Social Security ends up being tax-free in practice. The result is the same. The paperwork is different. And that paperwork difference is where the trap lives. Here's how the math actually works for a typical retiree in 2025. If you are 65 or older and married filing jointly, you start with the regular standard deduction. That's $31,500. Then you get the traditional extra deduction for being 65 plus, which is $1,600 per person, so $3,200 for a couple where both are over 65. That brings you to $34,700. Now, stacked on top of all that is the new ABIA senior bonus. $6,000 per person, $12,000 for a qualifying couple. That puts your total deduction at $46,700 before a single dollar of your income is taxed. For a retired couple living on Social Security plus a modest pension plus some IRA withdrawals, that stack of deductions can wipe out their federal tax bill entirely. We're talking about couples who owed $2,000, $3,000, $4,000 in federal income tax last year, owing $0 this year. That's how big this is. But, and this is the part that matters, you have to claim it correctly. And that's where Schedule 1A comes in. The senior bonus does not show up automatically on your regular Form 1040. It is not part of the standard deduction box you've been checking for 20 years. It lives on a brand new form called Schedule 1A, specifically in Part 5, under a heading called Enhanced Deduction for Seniors. If you don't fill out that specific section, the $6,000 per person doesn't get applied. Your taxable income stays higher than it should be. You end up paying tax on money you shouldn't owe tax on. Tax professionals across the country are reporting that roughly 25% of seniors filing their 2025 returns are missing this deduction entirely. Some are using old tax software that wasn't properly updated. Some are going to preparers who don't know about Schedule 1A yet. Some are filing themselves and never even see the new form. The cost of missing it is real. For a married couple in the 12% bracket, $12,000 in missed deduction means roughly $1,440 in extra tax. In the 22% bracket, it's $2,640. That's a mortgage payment. That's a month of groceries and Medicare premiums. That's the kind of money that matters in retirement. So let me walk you through the 4 traps that are costing seniors this money. Trap number 1. The I didn't know it existed trap. This one is simple but costly. If you file your own taxes using older software, or if you use a preparer who hasn't updated their training for 2025, Schedule 1 may never even come up. The IRS didn't send out letters announcing this form to every senior in America. They published it quietly. Most retirees are finding out about it from news articles or by accident. The fix: when you sit down to file your 2025 taxes in early 2026, ask your preparer directly, have we included Schedule 1A for the ABA senior bonus? Don't assume, don't trust. Ask out loud and make them show you the form. If they look confused, that's your answer. Find a different preparer. Trap number 2, the married filing separately trap. This one catches a surprising number of couples. Some married couples file separately for legitimate reasons. Maybe one spouse has student loan payments tied to their individual income. Maybe one spouse is protecting themselves from the other's legal liabilities. Maybe there's a second marriage with complicated estate planning. Here's the problem. The ABA senior bonus is only available to married couples who file jointly. If you file separately, you forfeit the entire $12,000 household deduction. Not half, not reduced, zero. For a couple in the 22% bracket, that's $2,640 in extra tax every single year for the 4 years this deduction exists. Over the lifetime of the provision, that's more than $10,000 lost simply because of filing status. The fix: before you file for 2025, run the numbers both ways. Calculate your tax burden as married filing jointly versus married filing separately. For most couples over 65, the joint filing will save more money than whatever reason they had for filing separately. Talk to a tax professional about whether the reasons you've been filing separately still apply in retirement. Trap number 3, the income phase-out trap. The senior bonus is specifically designed for middle-income retirees. It starts phasing out when your modified adjusted gross income exceeds $75,000 for singles or $150,000 for married couples filing jointly. Once you cross those thresholds, the IRS takes away 6 cents of the deduction for every dollar you earn over the limit. The deduction disappears entirely at $175,000 of income for singles or $250,000 for joint filers. This creates a situation where a couple with an income of $145,000 gets the full $12,000 deduction. A couple with $170,000 gets it partially reduced. A couple at $250,000 or more gets nothing at all. Here's what most people don't realize. Your modified adjusted gross income includes your Roth conversions. It includes your required minimum distributions. It includes realized capital gains from your taxable brokerage account. If you're doing a large Roth conversion this year, or taking a big RMD, you could accidentally push yourself over the phase-out threshold and lose thousands of dollars in senior bonus deductions without realizing it. The fix: If your income is anywhere near the phase-out threshold, consider a qualified charitable distribution from your ER. A QCD counts toward your RMD, but doesn't show up as taxable income. That can keep your MAGI below the threshold and preserve the full deduction. For some retirees, a $5,000 QCD can save them $3,000 in taxes by protecting the full senior bonus. That's a 60% return on a single paperwork move. Take a breath here. I know this is a lot of detail. You're doing great just by staying with me. Let me pause for a second to tell you why I'm making this video. Every year, billions of dollars in tax deductions go unclaimed by retirees. Billions. Not because people cheat, not because the IRS takes money, but because the tax code is so complicated that most retirees simply don't know what they're entitled to. The senior bonus is the largest, most widely available tax deduction for retirees in the last 2 decades. And fewer than half of eligible seniors are going to claim the full amount. That's not the IRS fault. That's not the accountant's fault. That's not the accountant's fault. That's the result of a tax code that has become so dense that even the people who are supposed to understand it are still learning. If you are 65 or older and your income is under $150,000 as a married couple, you are almost certainly eligible for some portion of this deduction. The question is not whether you qualify. The question is whether you'll actually claim what you're owed. Okay, back to the traps. Because there's one more that's particularly sneaky. Trap number 4. The expires in 2028 trap. Here's the part that creates real urgency. The senior bonus is not permanent. It's written into law to expire at the end of 2028. Unless Congress explicitly extends it, it disappears completely starting with the 2029 tax year. That means you have exactly 4 tax years to use it. 2025, 2026, 2027, and 2028. After that, if Congress doesn't act, the deduction is gone. ERA said, no retroactive claims, no grandfathering, no extensions. And here's where the retirement planning gets interesting. For retirees who have been putting off Roth conversions, these 4 years create a once-in-a-generation window. You can do aggressive Roth conversions now. Use the extra senior bonus deduction to offset a significant portion of the conversion tax cost and lock in Roth balances that will grow tax-free for the rest of your life. A married couple both over 65 with a combined income of $120,000 could do a $30,000 Roth conversion in 2026. Their senior bonus deduction of $12,000 would absorb nearly half of that additional income. The effective tax cost of the conversion drops dramatically compared to what it would be after 2028. This is not a small detail. This is a 4-year planning window that will never come again. Let me put all of this together with a real family example. Meet the Millers. Bob is 68, Carol is 68, Carol is 66. They're both retired. Bob gets $30,000 a year from Social Security. Carol gets $20,000 from Social Security plus $25,000 from a small pension. They also take about $25,000 a year from a traditional IRA to cover living expenses. Total annual income, $100,000. Under the old tax rules, before ABBA, they would have owed roughly $6,000 in federal income tax on that income, after accounting for the standard deduction and the traditional senior deduction. Social Security would have been mostly taxable. They would have written a check to the IRS every April. Under ABBA, with Schedule 1A filed correctly, their tax picture changes completely. The regular standard deduction of $31,500 plus $3,200 for being over 65 plus $12,000 for the senior bonus gives them a total deduction of $46,700. Their taxable income drops to approximately $53,300. Their federal tax bill drops to around $2,800. That's a savings of roughly $3,200 compared to what they would have owed before. Now imagine the Miller down the street. Same age, same income, same situation, but his tax preparer didn't fill out Schedule 1A. He checks the over 65 box like he always has. His tax bill comes out to around $5,200, $2,400 higher than the Millers. Same situation, same law, same IRS. One family claimed their deduction, the other didn't know the form existed. Over the 4 years, this provision is in place. That's nearly $10,000 in difference between the couple who knew and the couple who didn't. So, here's what I want you to do before April 15th of next year. Step 1. Pull out your 2024 tax return and look at your total income. Add up Social Security, pensions, IRA withdrawals, and any other income. If it's under $250,000 for a couple or $175,000 for a single, you qualify for at least some portion of the senior bonus. Step 2. Log into SAA.gov and check your projected Social Security for 2025. Add that to your projected pension, your expected IRA withdrawals, and any other income. That's your MAGI estimate for the year. If it's under $150,000 for a couple, you qualify for the full $12,000 deduction. If it's higher, figure out exactly how much the phase-out reduces your deduction. Step 3. If your income is within $15,000 of the phase-out threshold, consider a QCD this year. Donating $5,000 or $10,000 directly from your IRA to a qualified charity can reduce your MAGI enough to preserve the full senior bonus. This single move can be worth more than the donation itself in tax savings. Step 4. Before you file in 2026, ask your preparer directly about Schedule 1A, Part 5. If they look confused, that's a red flag. Find someone who specializes in senior tax planning. The cost of a good preparer is tiny compared to the cost of missing this deduction. Step 5. Plan for 2026 through 2028 now. These are the 4 years where the senior bonus is guaranteed. Look at your tax deferred account balances. If you have significant money in a traditional ERA or 401k, these are the best years in decades to do Roth conversions while absorbing some of the tax hit with the senior bonus. Before I close, I want to say something important. The senior bonus is a temporary gift from the current political environment. It could be extended beyond 2028. It could also be eliminated early. Politics in America being what it is, there is no guarantee of anything. The only certainty is the 4 years that are currently written into law. For retirees, the worst possible response to this deduction is to do nothing because you assume it will be extended. For every single year you don't claim it, you lose thousands of dollars that you will never get back. The IRS does not send apology letters. They do not retroactively adjust returns. If you miss this deduction for 2025, you can file an amended return within 3 years. But once those 3 years pass, the money is gone. The simpler the paperwork, the more people miss it. The more complex the paperwork, the more people miss it. In the case of Schedule 1, it's the second one. The deduction is so new, the form so freshly created, that even experienced preparers are still learning how to handle it. Don't be the retiree who finds out about this in 2029 when it's already gone. Don't be the couple who loses $10,000 over 4 years because nobody mentioned a new form. You worked your whole life for this retirement. You paid into the system for decades. This deduction is yours. It was designed for you. The only thing standing between you and $6,000 per person is one piece of paper that most people don't know exists. Let me ask you something before we wrap up. Think about someone in your life right now who recently turned 65, a sibling, a neighbor, a close friend, maybe a coworker who retired last year. Now imagine them sitting down next April and filing their 2025 taxes without knowing about Schedule 1A. They miss the deduction. They overpay by $2,000, $3,000, $4,000. They never know. They just assume that's what they owed. Now imagine you take 30 seconds and send them this video. You text it to them. You forward the link. You save them that money with a single click. That is not a small thing. That is a real, tangible gift that costs you nothing and could be worth thousands of dollars to the person you love. More meaningful than flowers. More useful than a gift card. A single share could put money back in someone's pocket that they would otherwise have handed to the IRS. Take care of yourself. Take care of your savings. And remember, in taxes, the people who win are not the smartest or the wealthiest. They're the ones who read the fine print and the ones who share what they learn with the people who need to hear it. Call your preparer this week. Ask about Schedule 1A, Part 5. Verify every line. If they can't show you where the senior bonus is being claimed on your return, find a new preparer. This is too much money to leave on the table because of one missed form. And if this video helped you understand something the IRS didn't bother to explain clearly, do one thing for me. Forward it to one person. Just one. That's how we fix this together. Not through politics, not through lobbying, through retirees, looking out for other retirees. One forwarded video at a time. You don't have to do this alone. You don't have to do this alone.